March 26, 2021. New York and London trading desks. Within hours, blocks of stock worth tens of billions of dollars hit the market. Shares of Viacom's fell more than 25% in a single day. Discovery declined sharply. By the end of the following week, global banks would report more than $10 billion in combined losses. The source was not a public company collapse. It was a private family office called Archegos Capital Management. How did a firm that most investors had never heard of trigger one of the largest trading losses in Wall Street history? To answer that, we need to understand the illusion that preceded it. Archegos Capital Management was founded by Bill Huang, a former hedge fund manager whose earlier firm, Tiger Asia Management, had faced insider trading and market manipulation charges in 2012. According to SEC proceedings at the time, Tiger Asia settled civil charges without admitting or denying wrongdoing. And Huang later converted his operations into a family office structure. A family office manages private wealth rather than outside investor capital. That distinction matters. Unlike hedge funds, family offices are not required to publicly disclose holdings in the same way. They operate with less transparency. Archegos qualified under that structure. By the late 2010s, Archegos had become an active participant in U.S. and international equity markets, according to subsequent regulatory filings and DOJ indictments. The firm built highly concentrated positions in a small group of media and technology companies. These included Viacom's, Discovery, Baidu, Tencent Music, and others. But the positions were not held through traditional stock purchases alone. They were largely constructed using total return swaps. A total return swap is a derivative contract. Instead of buying shares directly, a fund enters into an agreement with a bank. The bank purchases the shares and holds them on its balance sheet. The fund receives the economic gains or losses on those shares, paying financing costs in return. This structure allows significant leverage. According to later court documents and regulatory investigations, Archegos used swap agreements with multiple prime broker banks, including Credit Suisse, Nomura, Morgan Stanley, and others. Each bank saw only its own exposure. The result was hidden concentration. Because the shares were technically owned by the banks, public disclosures did not reveal Archegos' full economic stake. Meanwhile, the firm's exposure to certain stocks reportedly reached multiples of its underlying capital. The illusion was one of strength. As media stocks rose sharply in late 2020 and early 2021, Archegos positions generated large paper gains. Rising prices increased collateral value. Banks extended additional credit based on mark-to-market performance. Incentives aligned toward expansion. For Archegos, leverage amplified returns. For prime brokers, financing these swaps generated fees and trading revenue. In competitive markets, banks compete aggressively for prime brokerage clients. But subtle vulnerabilities were embedded in the structure. First, concentration risk. A large percentage of Archegos' exposure was tied to a handful of stocks. Second, leverage. According to investigators, the firm's positions were multiples of its equity capital. Third, opacity. Each prime broker had partial visibility, but no single institution saw the full picture. As long as stock prices rose, the structure appeared stable. In March 2021, Viacom announced a secondary stock offering. The move increased supply and pressured the share price. The stock began to decline. That decline triggered margin calls. When a leveraged position loses value, banks demand additional collateral. If collateral is not posted, positions are liquidated. According to court documents and DOJ filings released in 2022 and 2023, Archegos was unable to meet escalating margin calls as stock prices fell. The illusion unraveled quickly. Within days, banks began selling massive blocks of shares to limit losses. The unwind was disorderly. Some banks moved faster than others. By the end of the episode, Credit Suisse reported losses exceeding $5 billion. Nomura disclosed losses of approximately $2 billion. Other banks reported significant though smaller hits. Archegos collapsed almost overnight. The firm's rapid rise had been built on leverage, concentrated exposure, and derivative opacity. The growth appeared credible because it was embedded within major global banks. The illusion of success was reinforced by rising markets and competitive incentives, but the structure was fragile. Part 2 examines how the swap mechanism actually worked, how risk controls failed across multiple institutions, and why warning signs did not trigger earlier intervention. By the time Viacom shares began sliding in March 2021, the core mechanism behind Archegos had already reached extreme scale. To understand the collapse, the structure must be clear. Archegos did not simply buy large stakes in public companies. It used total return swaps arranged through prime broker divisions at major banks. Under these contracts, the bank purchased the shares and held legal ownership. Archegos received the economic exposure, meaning it gained if the stock rose and paid if the stock fell, along with financing costs. This structure created two critical effects. First, leverage, because swaps require only margin rather than full purchase value. Archegos could control positions far larger than its capital base, according to DOJ filings and subsequent indictments. Investigators alleged that Archegos' exposure reached tens of billions of dollars, significantly exceeding its equity capital. Second, opacity, since the shares were held on bank balance sheets. Public filings did not reflect Archegos as a major shareholder. Meanwhile, each bank saw only its own contracts and margin profile. No single institution had a full consolidated view. That fragmentation mattered. According to congressional testimony and internal bank reviews released after the collapse, prime brokers competed intensely for Archegos' business. The family office was viewed as a profitable client. Financing large swap positions generated trading fees and interest income. Competitive pressure influenced risk tolerance. If one bank tightened margin requirements, Archegos could shift exposure elsewhere. In that environment, maintaining client relationships became commercially important. Risk controls were present, but enforcement varied. According to reports commissioned by Credit Suisse and made public after its losses, internal risk management units had raised concerns about Archegos' exposure. Margin requirements were adjusted multiple times. However, as stock prices rose, collateral values increased, and perceived risk declined. Overconfidence bias also played a role. When a client consistently posts profits and meets margin calls, the model appears validated. Rising asset prices can mask underlying leverage until a reversal exposes scale. In early March 2021, that reversal began. Viacom announced a secondary offering on March 22, 2021. The announcement increased supply and pressured the share price. The stock, which had risen sharply in preceding months, began to decline. As prices fell, Archegos faced margin calls from multiple banks simultaneously. According to court documents and regulatory filings, Archegos attempted to negotiate with lenders, but margin calls escalated quickly as share prices continued falling. The decision point emerged over March 24 and March 25. Some banks began preparing to unwind positions if additional collateral was not provided. Others attempted to coordinate discussions with Archegos. Coordination failed. On March 26, several banks moved aggressively to liquidate shares tied to swap positions. Morgan Stanley and Goldman Sachs, according to public reporting and later disclosures, began selling large block trades early. The scale was unprecedented. Billions of dollars in stock were offered into the market in rapid succession. Share prices dropped further under selling pressure. That price decline triggered additional margin calls, intensifying the spiral. This was not a traditional fraud in the sense of fabricated assets. The companies involved were real, publicly traded businesses. The mechanism was leverage layered on concentrated exposure. According to DOJ indictments filed in 2022, federal prosecutors alleged that Archegos and Bill Huang misled banks about the size of aggregate exposure and manipulated certain stock prices through concentrated buying. Those allegations are part of ongoing legal proceedings. From a structural perspective, the key vulnerabilities were clear. Concentration risk. Archegos positions were heavily focused in a small number of stocks. Leverage risk. Swap contracts magnified exposure beyond reported equity. Counterparty fragmentation. Each prime broker saw only part of the picture. Governance gaps. As a family office, Archegos operated with fewer disclosure obligations than traditional hedge funds. When prices rose, those factors amplified gains. When prices fell, they amplified losses. The collapse was swift because the unwind required simultaneous liquidation across multiple institutions. By early April 2021, Archegos Capital Management had effectively ceased operations. The losses were absorbed primarily by banks. Credit Suisse reported more than $5 billion in losses. Nomura reported approximately $2 billion. Other institutions reported smaller impacts. The speed shocked markets. A private firm with limited public visibility had generated multi-billion-dollar losses at globally significant banks. Part 3 examines the investigations that followed, criminal charges, governance failures identified by regulators, and what the Archegos disaster revealed about leverage transparency in modern markets. By early April 2021, Archegos Capital Management was effectively finished. The firm's positions had been liquidated. Its counterparties had absorbed losses. Bill Huang, who had built the portfolio through concentrated swap exposure, retreated from public view, but the story was not over. The magnitude of bank losses triggered internal reviews, regulatory scrutiny, and eventually criminal charges. Credit Suisse was among the hardest hit. In April 2021, the bank announced losses exceeding $5 billion tied to Archegos exposure. Senior executives, including the head of the investment bank and chief risk officer, departed shortly afterward, according to public disclosures and shareholder reports. The losses significantly impacted the bank's quarterly results and capital position. Nomura reported losses of approximately $2 billion. Other institutions, including Morgan Stanley and Goldman Sachs, reported smaller impacts, in part because they moved more quickly to liquidate positions. The difference in outcomes became a subject of intense examination. In reports commissioned by Credit Suisse and released publicly, investigators found failures in risk management, margin practices, and escalation protocols. The bank acknowledged deficiencies in how it monitored concentrated exposure and enforced collateral requirements. The episode highlighted competitive dynamics in prime brokerage. Prime brokers generate revenue by financing hedge funds and family offices. Clients with large trading volumes are commercially valuable. That incentive can create pressure to offer favorable margin terms. Regulatory attention followed. In April 2022, the U.S. Department of Justice and the Securities and Exchange Commission filed charges against Bill Huang and Archegos' former chief financial officer, Patrick Halligan. DOJ filings stated that prosecutors alleged securities fraud, wire fraud, and market manipulation related to misleading counterparties and inflating stock prices through concentrated trading. The SEC complaint alleged that Archegos concealed the true size of its positions and misled banks about overall exposure. Those charges are part of ongoing legal proceedings. The allegations remain subject to judicial process, beyond individual accountability. The collapse raised structural questions. First, transparency. Family offices are not subject to the same disclosure requirements as hedge funds. After Archegos, lawmakers and regulators debated whether large family offices should face enhanced reporting obligation. Second, counterparty risk management. No single bank had full visibility into Archegos' aggregate exposure across institutions. Each prime broker assessed risk independently. The result was fragmented information. Third, leverage oversight. Total return swaps allow economic exposure without direct share ownership. While legal and widely used, they can obscure concentration levels from public view. Following the collapse, global regulators reviewed derivative reporting frameworks and margin requirements. The Basel Committee on Banking Supervision and other bodies examined potential reforms to strength and risk aggregation. The systemic impact was contained. Unlike the 2008 financial crisis, Archegos did not trigger a broad market collapse. Losses were concentrated among specific prime brokers. Equity markets stabilized after the unwind. However, the episode exposed how leverage combined with opacity can create sudden shock waves across institutions. Behavioral dynamics were central. As long as stock prices rose, Archegos' model generated profits. Rising collateral values reassured lenders. Competitive pressures encouraged banks to maintain relationships, but concentration amplified vulnerability. When Viacom's declined, the margin spiral began. Once multiple banks demanded collateral simultaneously, liquidity evaporated. The speed of the unwind reflected modern market structure. Block trades were executed rapidly. Price declines triggered automated risk controls. Margin calls cascaded. The collapse occurred within days. The Archegos disaster illustrates a recurring pattern in financial markets. Leverage magnifies returns during expansion. Opacity can delay detection of concentration. Competitive incentives can soften risk discipline. When prices reverse, the unwind can be swift and costly. It was not the largest financial fraud in history. It did not collapse the global system, but it revealed how interconnected derivative exposures can transmit risk across major institutions without public visibility. Today, prime brokerage divisions have tightened margin requirements. Regulators have increased scrutiny of large family offices. Risk committees place greater emphasis on aggregate exposure. The broader lesson is analytical, not moral. Markets reward growth. Leverage accelerates gains. But when exposure is concentrated and transparency is limited, stability depends on confidence and coordination. Archegos was a private firm. Its collapse was public. If you value carefully sourced analysis of financial disasters, white-collar investigations, and systemic risk, consider subscribing the channel for future documentaries.